You're a professor of economics at Tufts University, and you're also the director of Development Strategies and Governance International Food Policy Research Institute. Did I get it all right?
Yes, a deputy director.
Oh, you're the deputy director. Wonderful. Well, we're very pleased and honored to have you here at our studios. And I'd like to start right away with our questions, if you don't mind, so we save time, and especially with what's happening around the world right now. The global economy is slowing down, the Europe crisis being in the focus, and U.S. economy is slowing down. Everyone is talking about recession. Where do you see emerging markets going, being the emerging market specialist and the expert?
I don't think there is actually a global slowdown. It's true that Europe is in trouble, and it's true that the United States is in trouble. I still see growth in emerging markets as very strong, and a lot of that has to do with China and India as well. But let's focus on China for a minute. So China is, I think, one very important indicator of China's strength is the following. So Italy and Greece went to China to ask them to borrow some of their huge amount of reserves to help them restructure their own economies.
That's right.
And China turned them down for a couple of reasons. And I think, before I tell you, I think the fact that China turned them down means that China is not so heavily dependent on those markets, and it is not afraid of this slowdown in those markets, and is confident about its own future. And if I were an investor, I would be bullish on emerging markets. There are some problem areas, but the reason China turned them down was twofold. First, as I said, they aren't so heavily dependent on those markets. And second, it would have been very politically difficult for China to sell to its people, basically giving money to rich countries to help bail them out, while China has so many poor people in its own country.
So are you saying China is not shrinking?
No, China is not shrinking. China just China's doing two things right now simultaneously, which is consistent with China's dual track policies that they've been following for as far as I can remember. So on the one hand, they're focusing inward on investments targeted to the domestic market, which, as we all know, is huge. So there's enormous growth potential there. And at the same time, they are going outward. So in 2006, they initiated this what they call a Go Global policy. And part of it, so there have been a lot of state support to domestic firms who wish to invest, and these are private firms, as opposed to previously the state-owned firms were doing this. Private firms who wish to invest overseas, and the Chinese government is establishing overseas economic zones in several countries. So, what that means is that these are special economic zones that give preferential treatment to firms investing in industries that the government considers high priority. China is doing this in Russia. China is doing this in several countries in Africa and several countries in Asia. And I think that bodes well for growth both in China and in these other countries.
So you see growth potential in China.
I do.
How about in Turkey? Do you see, among all the emerging markets, where do you see Turkey? Do you see a growth potential in Turkey? And do you think that Turkey is resilient or protected or prepared against a potential European shock?
So Turkey is one of the more problematic cases. Turkey has done extremely well. Its manufacturing sector has taken off. It's until the slowdown in Europe, you could have held it up as an example. It's a country that people in Egypt talk about, people in Tunisia talk about. They all want to be like, they all want to emulate Turkey. Now the problem now is that Turkey has a pretty large current account deficit, and that's because in part because their export market is primarily Europe, whereas they import quite a bit from China. Of course, you know, there are other players, but these are the two major. partners that they have in trade. And imports from China have been growing while exports to Europe shrunk. And so they were able to diversify their exports to Europe. They were able to diversify by exporting more to Middle Eastern countries in the past couple of years. But that also has become a bit problematic in the recent past year, for example. So Turkey has had to devalue its currency, and there's not much scope for further devaluation because inflation is on the rise. So the government of Turkey is in a tough situation right now. But you know, China is not the answer to everything. But there is a tremendous potential for China and Turkey to enter into some mutually beneficial agreements. So China's investments in the West, for example, have largely been targeted at acquiring acquiring new technologies, and so there's a lot of scope for that in Turkey. And I think Turkey and China are in negotiations over how China might be able to help Turkey balance its current account better by offsetting some of the imports that flow from China to Turkey with investments by China in the Turkish economy, which would help to balance the current account deficit.
Interesting you say that. And also you said the depreciation of the Turkish lira is going to stop at one point. Like Brazil real, you know, it was devaluated almost 23% among within the last 2 months, especially with the European crisis going on, but there is now a slowing down. Do you think the Turkish lira is going to go to the opposite direction too with these developments?
Well, I mean, it all depends on inflation.
Okay.
So it's complicated, but the primary concern with further devaluations of the Turkish lira is inflation, because when you devalue and people stop importing, they turn their demand to domestic products, and that's what causes inflation.
And the government is capable of doing it? Do you believe in that? And or what should the government do in that sense?
Well, I mean, it's tough. The government can raise interest rates, but that also puts a slowdown on business.
Exactly.
So so it's very complicated. It's a delicate balance. The best thing to do, if possible, is to increase exports, increase productivity, increase exports, without having to further devalue if they can.
Okay, thank you so much for coming. This is leaving me with the last questions. Let's say 20 seconds.
Sure.
If you were to invest as an investor among the emerging markets, where would you see the investment potential? We talked about the growth potential, about the investment areas.
The growth potential is highest in Africa, hands down.
Okay.
And I would invest. I would pick my stocks by the countries I would want to live in. So that's, you know, Egypt, Ghana, Mali, Senegal, Nigeria, Ethiopia, Mozambique. Those are the countries I would.
We need to add Turkey in there, right?
Oh, Turkey, of course. Turkey.
Thank you so much, Professor, for coming and for your valuable comments to thinking. I know that you have to go to a panel right now to moderate it, and thank you.